Good evening, ladies and gentlemen. This is Clueless Trading Frank. Today is the 12th of December, 2016. This is a important and critical market update webinar. Approximately 8:40 p.m. Eastern Standard Time. Session will be recorded and uploaded to the Clueless Trading YouTube channel, which you should all subscribe to. Obviously, just put in your email so you'll notified any given time when I'm putting up my video casts, my reports and such. And also mention to all your friends and colleagues and referrals to go ahead and listen and enlighten themselves on the real mechanics of the market, the real deal, not the fluff. They're free to take advantage of educating themselves and informing themselves about the U.S. financial markets. Full disclosure, this is purely for financial education and not for any solicitation or advice. So let's kick off tonight. First, I'm going to start off with giving you all a very, very important component of what will happen on Wednesday with the Fed meeting, 3 different scenarios and the possible outcomes. That is the essence of game theory, where you have variable outcomes on a set number of variables that are input within the model, right? That's what game theory is all about. We do that all day long in our lives. And yet we don't realize that's exactly what's employed in the game of investing and trading, where there are no exact certainties, but high probability movements that we try to capitalize on. Some of them are capitalized on a short-term basis, on an intraday basis, or maybe a day or two. Some of them on a swing basis, and some of them on a longer-term basis. Simple as that. That's basically what game theory analysis is all about. You can read up on that, Google it. It's pretty fascinating stuff. So let's start off trying to make this as concise as possible within this hour. Don't want to keep it too long and lose people's attention. So scenario 1. Let me get my little scrolling pen. So scenario 1 is this is the Fed meeting stuff that I'm talking about now for people who are joining in. Fed scenario coming up on Wednesday, which is obviously going to be a very critical day for the markets. In a very long time, the Fed is going to raise rates. One with the other, they're going to raise rates, and we're going to talk about the scenarios. So what if they don't, and what they say? And this is not just a Fed meeting. This is one where you have a press conference right after that at 2:30. So it is not always what happens before the Fed meeting, after the policy announcement at 2 p.m., but then comes the volatility again at 2:30, and then, of course, we have no frigging idea what's going to happen by 3 o'clock, 3:30, 4 o'clock, but hey, that's what we do. Let's just start off with the premise that, and this is a fact, okay, and I think all of us should take into account, we know nothing. All right, we're all clueless in this game of what we do. What I try to do with the aid of my tactical charts, my pretty comprehensive knowledge about and experience on dealing with the U.S. financial markets, and of course a good element of luck, is try to make head or tail of what might happen, right? So let's start off with that premise that we know nothing. So scenario 1. The Fed does what it's supposed to do, which is raise the federal funds rate by a quarter percentage point, and gives the guidance, because the guidance is the key matter here, just like an earnings report. It's not just about the earnings. It is about the guidance that the company gives. So treat the Fed like a company giving a guidance on the Fed like a CEO of a company, management team of a company giving guidance on the U.S. economy, period. Simple as that. So quarter of a percentage point baked in. They do that, standard stuff. So let's say they give and this is the optimistic scenario. They give a positive guidance saying the U.S. economy is getting stronger. I'm going to put it just in quick shorthand terms. The U.S. economy is a plus, getting stronger. They're okay with the inflation expectations, and they see reasonably strong growth without worrying about runaway inflation, which is a very big danger. We do not want runaway inflation. And remember, inflation has two components: wage inflation, which is actually a larger component. Okay, people getting paid more. We think, oh, it's great, people getting paid more. Not very good when it comes to inflation expectations that are built into every corporate model and every economic model. You have runaway wage growth, and you have runaway commodity inflation, which is oil, which is moving pretty nicely. Then you have a problem. Then the economy overheats, and the Fed really has to step on the gas. What is stepping on the gas? You all know that. That is, they start raising rates at every frigging meeting. You watch what the market does. It's going to tumble. All right. So U.S. economy is okay. Inflation expectations are, I'm going to put inflation as I. So inflation is okay. They don't see overheating. They don't see any particular bubbles in any particular sector of the market, which don't forget that any comment, which is going to come during the Q&A session, any comment by the Fed that by Janet Yellen that she's seeing some form of bubbly type of behavior on an excessive speculation in any particular areas of the market, you are going to see the market tumble. We're going to talk about that too, what the levels we can be looking at if that happens. So scenario one is 1/4 percentage point increase in funds rate. U.S. economy is doing well. They're happy with it. Job growth, which I'm going to put as J, is full employment is doing well. They see moderate job growth going forward, which is exactly what we need. Because remember one thing, regardless of what you hear and what you know, all that good stuff, it is true that a certain section of the U.S. economy is the unemployment rate is pretty high. Okay, the U6 as they call it, but overall there is a very heavy shortage, believe it or not, and it's pretty much full capacity when it comes to skilled workers. Because this is the world is becoming a gig economy. It's a knowledge-based economy, right? So what's happening is the old line industries, whether you call it coal, whether you call it, you know, heavy-duty manual labor, this type of stuff is really, unfortunately, that's the unfortunate part of mechanization and technological modernization. Those jobs ain't coming back. Those trade workers need to be trained in the newer skills, and that's something that the new administration should focus on big time. I'm sure they will, because otherwise those jobs are not coming back. So the overall shortage in the skilled market industry, skilled job market, which is which is really the growth part of the U.S. GDP, is pretty tight. So you don't need like massive job growth. I mean, you need moderate, 200,000 plus or so every single, overall, give or take, on the employment numbers. But the bottom line is that you don't need there is a shortage. So that's it. That's the best I can go. I don't want to get into employment stuff too much. So job growth is okay. They are feeling good about what they see in 2017, all that good stuff. The market will basically go higher. Okay, so I'm going to put an arrow. The market will go higher, hit levels, and I'm going to show that in a second what the upper levels could be, and it's all pretty much in this chart alone. It's not that hard to figure out, and the rally projects out, extrapolates out a little bit more. And we possibly hit that. We're only 200 points from 20,000, right? I mean, come on, 200 points. You can get that in 20 minutes in these type of algo HFT driven markets. So we could possibly at that point hit that 20K mark, maybe by Friday, So not that hard to imagine when it's only 200 points away on the Dow Jones Industrial Average. Second scenario, the Fed comes in and raises rates, federal funds rate, 0.5 percentage point. unexpected. Okay, the bets are not in that side of the table. You see the markets immediately fall, Okay, you could expect to see the market fall anywhere from 100 to 200 points within a matter of 15 minutes. Fast. That's it. All right. And then the Fed gives guidance that they're seeing an overheated economy. They feel that if they did not raise it half a percentage point, they might be forced to raise it faster and quicker going forward. So they would rather. Oh, I forgot to mention one thing. One of their more moderate statements, which would be the rally continuation type of scenario one, is that they expect they raise rate quarter of a percentage point, and they don't foresee repeated rate hikes going forward, that maybe one or two more in the following 6 months going into next year. I don't think they're going to go far into saying, oh, we're not going to raise rates anymore for the remainder of 2017. I mean, going into 2017, I don't think they're going to say that. They can't say that. But that they are in a moderate pace and they'll be evaluating the data and all that stuff. So that's music to markets' ears. All right. So I forgot to mention that in scenario one. So those are good things. Half a percentage point, the market will drop roughly 200 points really fast, which would bring us down to that 19,600 level, possibly 19,500. There will be severe damage on individual stocks, especially the high momentum stocks. You'll see those days, which we have gone to quite a few of them, where you're going to see the Amazons of the world, the Googles of the world, the Priceline of the world drop anywhere from 15 to 20 points. Well, Priceline drops 20 points on a sneeze anyway, because on a percentage basis, that's nothing. But you'll see some pretty substantial drop across the board. Banks too. I'm sorry, not banks. Banks in that case would like that scenario initially, then they will sell off. So, and then they give guidance that if they didn't raise the rates half a percentage point, they would be forced, and no one wants to hear that word, that they would be forced to basically raise consistently, and that after this half a percentage point, they look to sit back a bit and see how the economy reacts. Whichever the case, the markets will drop first, and then possibly within a matter of 24 hours or so, you will see a rebound in the markets. Why? Because just the way markets are, and we have seen this happen all the time, the powers that be, who know pretty much what the interpretation of that language is, and all of you included, and other so-called gurus out there, they are always going by the verbatim what the Fed says. And honestly speaking, the Fed speak is a skill that you have to master. It doesn't matter how good you're with English. You wouldn't know what the heck the Fed is saying unless you understand the dynamics of central bank and economics, macroeconomics. So the powers that be will come out and then they'll basically defend the market and say, you know what? Fed's actually very bullish about the U.S. economy, and this half a percentage point move is actually a good thing because it is saying that the U.S. economy, the GDP, might be growing at 4% going into next quarter, which is sort of the stated goal of the new Trump administration, right? So this is a good thing. So the U.S. economy is in a strong footing. It's going to drag the GDP higher and the global markets higher. So the markets will rebound. Just to be quick. All right, initial drop, oh my God, what's going on? Now we're falling. You know, we're going to go down to 19,000, all that garbage you're going to hear, and then the markets will rally over the next 24 to 48 hours going into Friday, which is monthly options expiration, generally a very bullish event, and mind you, till only the first half of the day. Keep in mind, Friday in itself is not, monthly options expiration is not a full day bullish event. Generally speaking, by the first part of the morning and early afternoon, those calls that you might be getting all bubbly about and excited about should be dumped for nice profits. Just letting you know. So saying all that, we are coming in. So that's the second scenario. All right. First a drop, then a reflex bounce. We don't know whether that's going to be a continuation bounce or whether it's just going to be a reflex bounce which will be sold. That's the second scenario. And the guidance is very, very important. What do they see after that? Do they continue to raise rates repeatedly, half a percentage point? In which case, you're going to see a 500-point drop in the, of course, they're not going to say anything like that. 500-point drop in the market in the blink of an eye. Scenario 3. Can somebody tell me what scenario 3 is?
Hold the rates.
I'm sorry, what?
Hold the rates.
Yes, that's correct.
No.
Yeah, exactly. No rate. Yeah, you're absolutely correct, Corey. So scenario 3 is 0 rate hike. You're going to see an immediate drop in the market. Immediate drop in the market. That will basically be in that range of 200 plus points. And then we don't know what's going to happen after that, because the 0%, because the market is so geared right now, or the expectations are so high that you're going to see a 0%, that you're going to see a rate hike, and then you get no rate hike. Okay, you get no rate hike. That means something is really wrong out there, and the banks, the financials will tumble. And good old Goldman Sachs, which has been the torchbearer of this, one of the few torchbearers of this entire rally, okay, from that original level when we were trading into it, 160, 170, all the way up to 243 or more, you're going to see financials, which I'm going to put as FIN, tumble. And that's going to drag the market and the Dow and stuff, like, it's going to be pretty severe initially. So and then in the question and answer session, where she's going to be grilled, these are the questions that and I don't have a cheat sheet here, okay? I'm just telling you from what my knowledge is and what I've seen over the years. These are the questions she's going to be asked. Number 1, does she see the U.S. economy moving forward? U.S. economy moving for a higher and a solid pace as it's doing going forward? Question. That's going to be one of the questions. The second question, or second or whatever, it could be the first question, is what she think about inflation? Does she think with oil prices heading towards 60, does she expect, and with this massive stimulus that's coming our way, which is certainly coming, okay, which is going to increase the federal deficit and the budget deficit by a good $1.5 trillion. Don't forget that till 2 years ago or so, the biggest concern was the ballooning deficit, right? We forgot about it, right? We did forget about it. No one talks about the exploding deficit anymore, because now the focus is on stimulus. What's the difference between a stimulus and a deficit? Well, if the stimulus of, let's say, $1.5 trillion in building up the U.S. economy goes into place, you're going to create a significant amount of jobs, couple of million jobs right away, in fixing the bridges, the airports, you name it, infrastructure. And that is going to create more money in the pockets of American consumers, so hopefully they'll spend. The U.S. consumer spending is 70% of the U.S. economy. So automatic boost. So the stimulus, so despite the fact that the deficit is going to absolutely skyrocket, that the U.S., the higher U.S. growth, GDP growth, and the U.S. consumer spending will offset that. In other words, the U.S. growth, accelerating growth, let's say to 4%, or 3.5% or 4%, will offset the ballooning debt, because it'll be easier for us to go ahead and pay down the deficit. In other words, the simplest way to look at it, it's like somebody saying, okay, I'm going to go out there and spend $100,000 on my credit cards, but if that person's income is rising correspondingly, then it's very easy for them to keep up with the credit card payments and not go into a severe financial situation. And really, it's as simple as that. So income versus, it's a debt to income ratio, right? That's the way you look at it. So if income's going higher, you're in a much better position to service that debt. So it's the same theory that's getting played out right now. So that this a massive stimulus will certainly explode the deficit. And believe me, there are deficit hawks out there in both parties. both parties, and they're going to fight that. They're going to be very careful about going out there and totally writing a blank check for $2 trillion or $1 trillion to go out there without knowing who's paying for it. Remember the term we used to say? Who's paying for that? Well, who's going to pay for this? Well, hopefully the U.S. economy will pay for it, backed by by increased GDP growth and wage growth. So she's going to be asked that question. She's also going to be asked a question about politics. That what does she think about the Trump administration's plans, and does she feel threatened by some of the attacks that were leveled against her during the campaign period? But that's a different time zone. I mean, that was the past. Now it's the present. Trump and his advisors have moderated and been extremely polite to Janet Yellen, because I'll tell you one thing: if Janet Yellen, if they had forced, which they said right away when they came, if you remember, I posted that too, that they have no intentions whatsoever of asking Janet Yellen to step back. But if they had gone ahead, and because in a funny way, the current stimulus plan needs somebody like Yellen to keep on suppressing the rates. Otherwise, imagine trying to add another trillion or $2 trillion on top of the gazillion dollars in at least in paper debt that's there on the Federal Reserve, and having to service that debt as interest rates are rising fast. Not a fun scenario. You guys don't want to be there. Okay, so believe it or not, good old Donald needs Janet Yellen at the Fed, and he was very diplomatic about it, but she's going to be asked that question. And as long as she gives a standard, polite, diplomatic answer, it's going to be okay. If there's any hint that she's looking to leave sooner than her term ends, the markets are not going to like it. Period. Okay? Period. I don't care who comes after her. Because if a person comes after her who's a real hawkish, who's really tough on deficits and stuff, it's going to completely blow up this grand plan that we have in place for the grand stimulus. Does everyone understand that? Does everyone understand that or no? Okay,
Yes.
All right. It's pretty simple. In a funny way, Janet's Trump's girlfriend right now. Okay, how about that? His date. There's no way he can piss her off, and there's no way he's going to say nasty things about her. So the bottom line is they both need each other. Actually, she doesn't need him because she doesn't care. She can leave anytime. So, but I believe she's going to continue with what she's doing, and going to work with the new administration in setting this in place. Because if a new guy comes in and he's really tough on deficits and stuff, I repeat again, this grand plan of this $1 to $2 trillion stimulus is going to get blown out of the water. And that's going to be a disaster, because this whole market rally has been predicated on the fact that we are going to basically get a massive stimulus. We're going to get corporate reform, which we're certainly going to get, and all kinds of good stuff. So that's really what's going to happen. 0%, we're going to drop real fast. 0.5%, we're going to drop fast and bounce. 0%, there's going to be a lot of questions asked, and this is obviously the best scenario. So let's take a look at the charts here and see what we see. So this chart is very well drawn. In fact, it's very precise. And here are the levels. Now this is a chart of the E-minis, so you just have to add. It shows here 2251. Let's call it 2252. So you have to add roughly about 5 points to it, to this number, to arrive at the SPX number. So just do that quickly in your head when we're talking about this. So the first channel, this is acceleration channel. This deep blue line the lower end of this channel is 2239. So real quick, let's add 5 points to it. So you're looking at about 2244. I mentioned that several times today. In fact, even earlier in the day, we are most probably going to touch this lower channel, which would be actually very healthy before the Fed to lose excuse me, to lose about 12 S&P points, which roughly translates into 60 to 72 Dow points, and that would be nice. And so that as long as we stay within this rising acceleration channel. These charts are not drawn for fun to amuse people. These are drawn so that that everyone can track them, track them on their own screen, and hopefully manage their profits and generate whatever they're trying to do with the markets. So this would be a healthy thing. This is the broad channel, the macro channel. This too, and remember these channels have been drawn off that enormous 800 point drop after hours in the market right after elections. So it does encompass the whole range of where we are coming from. Okay, so that's your acceleration channel. Actually, this is acceleration channel number 2, and this is that fat, out of control acceleration channel that we have been in since the 6th, since the first week of December. Right there, you can see that. So let me clear up the screen a bit so that everyone can focus on that now that we discussed it. Oh, one big caveat, one big important reminder for Wednesday. Markets are going to be super fast. So unless you guys are really focusing a little bit on your own screens, don't trade. Really don't trade, because I'm not going to, I say I'm not going to, and I still do. I'm going to be posting the charts. I'm explaining to you beforehand what I expect the scenario to be in all circumstances. But if you can't handle what we call extreme skiing, on these SPX and RUT calls and puts, it's going to be pretty dramatic. All right? Just don't trade. Just sit back. Because if you're not fast enough, you're just going to get shot. It's like a video game. And there's no point in being stupid and losing money. So use your brains, okay? So if you can handle being near the screen during that period, in fact throughout the day, do that. Otherwise, don't be stupid. All right, please, because I've been stupid, so I know. And I'm telling you, it doesn't matter how good you are, how fast you are, how well you understand. Maybe you're inside Janet Yellen's head. Doesn't matter. The algos and the HFTs are going to move at speeds, and we've seen that before, which are going to be just outrageous. All right? So that's just a word of warning. And that applies to any days which are extremely volatile, and you can handle the volatility, because most of you can handle volatility. I'll tell you the truth. All right? You're not ready for it. I know you're trying. It takes time, and you can handle volatility. Just don't be there. That's all. Simple. So saying all that, so this is so here's this is the real acceleration channel, the rising wedge, and we fell out of the rising wedge today. You can see that, this blue line, and this started on December when the market was supposed to come down a little bit more. Forget it. It didn't even bother. It turned around, and we had this 1, 2, 3, 4, 5, 6 candle rally, and then we have this wedge formation, consolidation channel, which I've shown on my multiple charts today, forming. This consolidation channel in the most bullish front should test this lower level, which is like I said, it's approximately 2245 or so on the S&P. Now intraday, I put the charts out there in much more detailed fashion, so you can, you can't get any better than that. Okay, this is like babysitting on steroids. All right. So and a warning: never give babies steroids. I'm just saying, this is like babysitting adults on steroids. You know what I'm saying? So that would be the most optimal scenario. Going to be quick, but most optimal scenario, and the market basically at that point comes up here, either breaks out or maybe pulls back. I can't project that that fast. Second scenario is we break below that, fast and furious. We fall here down to the bottom of this very wide, very wide range that we're traveling in, and that would mean we're looking at roughly 2232, call it 2230 on the S&P 500. And that would be at the bottom end of the range, which it held when we retraced and then we took off. Pretty simple. It's actually very visual. You don't need to even know the dynamics of S&P and stuff. It's very visual. This is a wide range we're traveling in. And so that's the second scenario. Third scenario is we have a breakout level here where this arrow's been put on. These arrows are not put on for Christmas decorations. They're put on there for tactical inflection points, right? So so that level is 2214, which translates into 2220. The one that Dano keeps on screaming about all the time. He seems to be fixated with 2220. But he's right, because below 2220, we are falling hard. And the 2220 level is basically this short-term breakout level right there. So 2214, add 5-6 points to it to arrive at the SPX number, you're looking at actually 2220, right? So 2220, if it hits there, it's going to have a reversal bounce. If the market does want to go down, it's going to try to enter this big, broad channel, this one, right? Fails, let's say, then you're going to see a rapid descent, rapid, one of those big fat red candles all the way down and take out and come down and test 2180, which is roughly 2185 on the S&P 500. Now, if it does come down there, what kind of pattern do you think it's, and then the market holds here? Let's say this is this was the other breakout. This was other breakout level. What kind of pattern is the market at that point developing? And let's say this is, I'm already giving the hints that this is a solid level of support, because the market's all about fake outs, right? So if it comes down there, what does it look like?
Inverse head and shoulders.
Inverse head and shoulders. Okay, so let's take a look at this. Where do you see the head? No,
The first arrow.
I'm sorry, what? This
just
one?
Above your pen. The arrow just above your pen. Yes.
This one?
Yes.
Okay. If that's the head, then where is the left shoulder? Okay, I'm not going to question you here. Look, this would be considered a head and shoulder, this pattern. Okay, this is the head. This is the head. And then you try to bounce and you fail. That's known as a head and shoulder, okay? From this side we rose, and then this becomes the left shoulder. This becomes the right shoulder. That's an actual head and shoulder. So this one is here. This is real important, believe me. And this one is here. And then you have a neckline, which is basically here, that it falls under. And this is the neckline. This green line here. Do you see the pattern? Yeah. No, but you're right. It's a head and shoulder, but it's actually a head and shoulder pattern that's developing if this happens. However, you actually answered it correctly, but the wrong pattern name. If we hold here, it then becomes a very large W formation, known as what?
Dragon bullish.
That's right. That's right. It becomes a dragon bullish formation. It's a little skewed because in the reality of markets, it doesn't look as pretty as it always does when we're doing our ACS sessions and stuff, right? So it becomes, so if it does become, if it holds real solid, remember, it's not just the Fed. There's all kinds of stuff going on. There could be another piece of news coming out that, from Europe, which is positive. There's so many moving parts. And if they don't want to take the market down and crash it to any wild degree, and I think the worst crash that we could possibly see in this holiday season, in my opinion, is at around the 2160 S&P level. That's my opinion. That's the lower Bollinger. And that's going to feel pretty hard if you guys are not really, not necessarily concentrating, if you're not really cognizant about what might happen. Because falling from 2256 down 100 S&P points is a good solid 500 to 600 points in the Dow. Back to 19,100 or 19,200 is not going to feel very pretty if you have your head stuck in the ground. All right, just letting you guys know. So I think that's the max move that the market can make. However, even if it comes down here, and of course I'll be working as hard as I always do, letting you guys know, what I'm seeing on the algo HFT charts and so many other things that I'm trying to analyze. It will become a definitive, powerful, just like it was here, a powerful buying opportunity, a big one. So if you've missed out on a bunch of large moves, this would be, in my opinion, if it holds. And I'm not showing the internals and stuff right now. If it holds, it will become a powerful move up, which would basically be good for, if it's 2160 here, you are looking at another 400 to 500 point move higher going into Christmas. Somebody says, oh, that can happen. Well, they don't know what the heck they're doing. It certainly can happen. So here, the media and a lot of you are going to feel like, oh my God, this is it. The bad old days are here. All kinds of stuff, and then bang, the market turns around and goes higher. It could even fall as low as this lower Bollinger. That's why charts are so important. It doesn't matter what we think, what your feelings are, whether you think Santa has a white beard or a red beard, okay, or even Santa exists, like some people think that he doesn't. He does exist, right? He's a North Pole, isn't he, Shawnee?
That would be correct, and I have worked for his elves.
Yes, exactly. And you did paint his house, right, at one point?
I had a lot of little helpers. It took a long time, but yes, we did.
Okay, we're gonna discontinue the conversation with Shawnee here because she was in the North Pole for a while, so I figured she was the authoritative figure on telling me what was going on out there. So saying all that, all kidding aside, we could have very much a rally like that. Now, if it doesn't enter this channel, okay, this broad channel, which is basically I think the sort of the massive buying exhaustion, where it's just going all the way up to that 2300 plus level in the market, 2360, 2380, it's just going to feel humongous, right? It can happen. It can happen. I highly doubt it, though. I mean, for a market to move up all the way up to almost 2400 just in the next couple of days left for the year, I think is a stretch, in my opinion, but who knows? Who knows? We've seen some very strange things lately, so it could happen. But I don't think that's a low probability trade. The other trade, which I think is more feasible, is the market comes down, tests this level here, which I said was good for about about 200 points, 150 points or so, and then you take a big shot up, and we get to where I think we get to, where I have this arrow drawn from last week. That's why I said, please take a good look at these charts when I post it. They're not there for Christmas decorations, which would be around the 2340 level. 2340 would be a reasonable 60-40 chance for the markets to get to. So let's do the math here. We closed at 2356, 2340. That's I'm sorry, 2340 minus 2256 is roughly 84 points times 5 or so. So we're talking about another 400 points in the Dow, which brings us to 20,200. Remember, when we hit Dow 20,000, if we do, it's not going to stop there. There's going to be an overshoot. And that's the overshoot we are talking about here, where the Dow Jones will print somewhere around 20,000. It's going to make huge headlines. It's going to be just huge. Okay? It's a statement by the markets that we believe what you're trying to do. The new administration's coming in. And this might happen, by the way, that overshoot by the first week in January. Because there's going to be some heavy selling the second week of January as tax-related selling and such comes into play in the new year. Tax deferment and things like that. People not selling in 2015 to pay lower taxes in, 2016 to pay lower taxes in 2017. You guys have heard that argument, and it makes a lot of sense. So Dow Jones at that point could hit 20,200, but it could be delayed till the first week in January. But the market basically continues its ascent in this within this range. And that's the most bullish optimistic scenario that I can think of in my head at this stage. Corrections are good because it's a slingshot effect, right? So you pull back, and then you that's why it's called the coil spring. You pull that spring, and it basically gets a lot of kinetic power as you're pushing it down, and then bing, it keeps on going. So that's exactly what markets do. So if you have it's just simple physics. Get a spring, just push it down, coil spring, and then it just springs up. And that's exactly what markets do. First, they bring it down. I call it the slingshot routine. And then they let it go. They pull it down 9 days, 10 days in a row, and then bang, they let it go. Which brings me to, so this is pretty much what my scenario is. We can pull back down towards the 2230 level, which is roughly around the 100 to 150 points from here, down, and then move higher. This could all happen within a matter of 2 hours on Wednesday, just letting you know. All right, so end of story. Now let's talk a little bit about what's happening with the market on the behavioral front. There's a lot of people, there's a feeling of optimism. We know that's normal. There's a feeling of optimism. There are people like things I've explained in my free market webinars, as well as my advanced coaching sessions, that a lot of mom and pops are finally opening up their statements. They're looking at their 401ks. They're feeling good. They're calling up their mutual fund guys or maybe their pension fund guy and say, hey, listen, maybe you're going to put some of my money market that I've been sitting on for years and years and years. I don't know why, because we're up a gazillion points from 2009. But that's retail behavior. They always come in on wave 5. We're in wave 5 right now, guys. Okay? It's Elliott wave theory. We're in wave 5 of this move. That's where euphoria starts to creep in. We're not euphoric yet, overall. Because why we're not? Because a significant amount of those trillions haven't come back into the market yet. Euphoria stage is when mom and pop literally, call up their brokers and their mutual fund guys, and they want to put all their money into emerging markets or growth-oriented funds, and they all want to buy the Russell 2000. And the worst part is if all of them wanted to buy Russell options, call options, then you'd be shorting the market like kingdom come, right? So bottom line is we're not there yet, but we're at the beginning stages of that euphoric move. And it takes time to build. And this is a very important point that I wanted to mention because all of us go through it and some of you go through it more. When we were coming down here after moving sideways and we were coming down here, what was the most common question that went on through retail traders thing, even posted in our room? Nothing wrong with that. What was the most common question people were asking? Come on, it's a simple question. What do you think? When we were consistently falling for 1, 2, 3, 4, 5, 6, 7, 8, 9, almost 10 days, what was the most common question or that was going on through your heads, and justifiably so, being asked, so that in the room, so to see whether I knew the answer or not. I didn't, but I could. I was showing what was going on. What was the question? Come on.
How low is it going to go, and when will it stop?
Yeah, exactly. Thank you, Brian. It takes one person, well, you guys all of a sudden conveniently forgot. Yeah, thanks, Brian. You're absolutely correct. Oh, that's it. It's like we're going lower. The S&P is going to go to 1900, 2000, and blah 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 blah. And in the meantime, I'm showing all these tactical charts, not always defending it because this was a difficult time too. Because there were a lot of fake outs. They were trying to bring the market higher, and it's not an easy time. I admit that. But the common human aspect of it was, oh my God, how low can we go? Where's the bottom? That was the question. Where is the frigging bottom? Are we bottoming yet? Where is the bottom? How low can we go? You couldn't hear anything else, even though the McClellan oscillators were minus 300, minus 400. It was just like, you couldn't wake up without seeing, stocks, the big cap stocks being down $5, $6, $7. So the question was, where's the bottom? Couldn't get away from that question. Doesn't matter. No one wants to look at charts. It's the same old story. Look at this pattern here, ladies and gentlemen. Does this look exactly the same as this? This went down for 1, 2, 3, 4, 5, 6, 7, 8, 9 days in a row. Correct? Let's count these days here. 1, 2, 3, 4, 5, 6. 7th day, little consolidation. So let's say 9 days. So let's say we go up 1, 2, like I think it's going to go up to the upper end of this channel, somewhere past 2,300 or close to 2,300. So that makes it plus 9. This was minus 9 days. This was 9 days, and this, let's say, plus 9. Look at the length of this distribution if we get up to that level. It is exactly the same as this. In fact, I'm going to clean this out, and I'm going to just show this because you guys have to understand this. This is not about heavy-duty PhD, database and analytics and quantum mechanics. This is about common sense and understanding your own behavior. I try to understand my own behavior, and hopefully I'm improving. I don't know. Face facts, guys. Stop hiding like an ostrich with your head on the thing and saying, seriously. That's why sometimes I get annoyed, because it's common sense. Look at this. This is exactly the same. Where's the bottom? I'm going to put B. And here, many questions arise, and rightfully so, asking, where's the top? Well, I've shown what the tops and bottoms are based on at least high probability moves on the levels that we discussed. And my charts are very, very clear on that. And this is just one chart I'm showing. So what I want to highlight on this point from a behavioral game theory standpoint, this is exactly what's going on. As traders, you're engaged here. You're engaged here. You're somewhat engaged here. There is no difference. It's just the flip side of the other of the coin. There's the other side of the coin. Behavioral-wise, it's exactly the same. The frustration, like, oh my God, do I buy here? Is it too high? Blah, blah, blah. And, he said, and the question here was, do I sell here? Is it too low? What if? Same thing, same stuff here. Where's the top? Where's the bottom? That's it. So from a standpoint of where we can go, I'm going to repeat it again, and this is just one chart showing that. And I will just mention this for once and for all, guys, because, I try real hard. You guys don't really understand some of my charts, or you don't really look at them or try to figure out, because I don't know how much easier I can make. I draw nice red lines. I draw yellow lines for pivots, which are very critical. Above pivot is good. Below pivot is bad. I draw red lines for support, green lines for resistance, white grayish lines showing, upward movement. I draw arrows. I even change the looks of the arrows to make it more exciting for people. How about that? All right. And aside from that, the intermingling and the correlations between internals and this and that, well, that takes some work. And that takes a little bit of the coaching stuff that I do, and that takes your intelligence to go into play. But honestly, when people ask me dumb questions without looking at my charts, it gets annoying in the middle of a trading day, honestly, because I'm not obligated to answer those questions, but I do because I like you guys. So have some respect, okay? And don't come up with, total dimwit questions or statements when you haven't reviewed the charts properly. And remember, those charts you can replicate on your screens too, because a lot of my charts are done on Thinkorswim, and many of you use Thinkorswim. This is investing.com. I keep on repeating, it's a free program. You can draw this yourself. Need some help? Talk to me. I'll help you out, set up the things. All right. So on the upside, I'm looking at 2280. I believe, yeah, here, 2280. And possibly 2300. On the downside, I can expect as low as 2220 Any breakage of it gets real tricky if it breaks the channel. I'm letting you know that. And if this candle develops into a big red ugly candle like this, don't be a hero. Okay, that means some severe selling is coming into the picture. And I'm obviously not going to sit quietly. I will mention that too, because if this hits this lower channel with the thump, what do you think is going to happen? This dark blue, which is the intermediate channel, this dark blue one. If a large sell candle happens rather quickly and hits this blue line with a thud, what do you think is going to happen? Please, I need some answers, or else I'm wasting my time, honestly.
It's going to keep going further.
That's right, Corey. You're absolutely, that's correct, because it'll be such a sharp, heavy sell move, heavy pressure, like a hammer dropping. It will continue to go down, and here is where it's going to find support. Thank you. Here it's where it's going to find support. If these simple things don't make, like Corey answered just without even thinking, if these things don't come naturally to you, please don't trade. Because after all this time and I don't need to teach you that, you guys should know, you get a large fat red candle like that, it's obviously going to break that channel. Try dropping a 50-pound bag, bricks or whatever, 100-pound bricks onto a plastic surface. You don't think it's going to break? So it's simple as that. So if this happens, the faster and quicker it happens, and of course we want to be on the right side of the coin on that, on the short side, the faster and quicker it happens, the faster it's going to bounce. I've always said this, and it's always been right. The algos, the faster they reset, and it stays within this channel, the faster you're going to see a retracement bounce. End of story. It's just the way it is. All right, let's move on. Now, all this can translate into managing your profits right, not being stupid when the markets are falling apart and you think, oh, well, it's going to bounce from here. This thing is moving up a little bit. Because one thing I've learned the hard way for years now, and now it's getting worse, is there are so many false signals in the market the machines are giving. It's not even funny. So these things are critical in you managing your trades. Let's take a look at so that was your S&P. That was your S&P. That's the whole kit and caboodle from post-election. Okay, post-election. And let me see if I have the stochastics here. And this is a daily chart, so it's cutting out a lot of the noise. Looking at the stochastics here, the daily has crossed down. However, as long as the channels hold, you can rest assured that we are not going to get a reset of this magnitude. If we get down here towards that 2180 level or so, after breaking the channel, then we're going to get a reset of this magnitude. Just so you understand that. Otherwise, it's going to come down here. There's a support level here. Remember, we had a little pullback here too, just a couple of days ago, at the end of November. And yes, at the end of November. And it'll come down here and it's going to bounce. It's going to bounce like that. This will only happen if we hit these lower levels. End of story. And of course, I put out real-time charts out there, so all you guys got to do is replicate that on your screen and follow the same parameters that I'm showing, and use your own judgment on what's going on what do you think. All right. In the meantime, this is the first consolidation sell candle, and I believe that it goes a little bit lower. That's my opinion. That doesn't mean it's going to happen tomorrow morning. It could happen maybe 15 minutes before the Fed meeting, for all I know, or after the Fed meeting. Here's your Russell 2000. Strong upward momentum stocks and indices don't just naturally decide to die. It doesn't work like that. You hear a lot of people saying, oh, the Russell 2000 is really overbought. Yes, it would be really, really overbought on a fundamental basis if there was a lot of participation. There hasn't been a lot of participation in the Russell 2000. Yes, there are hedge funds who are getting short squeezed to death and new funds who are buying and such. But in general, there hasn't been real participation in the Russell 2000. That's why you see so much strength. Now, I drew these literally to perfection, and this is exactly what it's going to do. If we slip, we come down to the lower end of the scale. That's around 135 on the IWM. Anything below that, you're talking a different story. This is where we started the journey at around 1300. I said it was going to go to 1340, 1350. It just took everything out, and then it went to 138, and then it went to almost 1400. Sounds incredible, but Russell 2000 can go a lot higher. And just a few months ago, in fact, a month ago, month and a half ago, they said this was the worst performing index and blah, blah, blah. You just wouldn't touch it. I mean, terrible. Terrible what these guys do, you know, to people. So saying all that, here we have a consolidation channel, a sharp one, and we could slip lower. So monitor this chart when I put it out there. Of course, see it on your screen too. It's pretty defined what it's doing. If it continues to go higher, we have a powerful downtrend line, which is here at 138. If it breaks out above that, God bless the shorts. It's going to be just a massacre. It's going to go straight up. Probably going to hit 1400. How high do we go on the RUT? On the RUT, we have gone as high as 1388 and then we closed at 1373. It can go to 1400, just as a round number. If the S&P hits 2300 or close to it, the Russell 2000 will go to 1400. End of story. All right, so let's move on to SPX. At this point, you have to be very tactical, and you have to trade with one eye looking back. Okay? In other words, you have to be very careful. Yes, I didn't think it was a great short to short the market when the McClellan oscillator, I kept on writing, and many of you understood what I was saying, was down at minus 369. This is heavy oversold condition. Look what happened to Boeing after hours. Can somebody tell me what happened to Boeing the other day? Boeing just issued a $14 billion buyback, increased its quarterly dividend, and said, what the heck with the cost overruns on the, whatever it is. The 74, what is it? It's a 737, right? 747, the Air Force One. Cost overruns Air Force One, and the stock's like going berserk. I even put it out there, even though I'm not trading Boeing. I mean, that was big. That's what these companies are doing. So there's your channel, and this is a channel that the market's going to basically move back and forth for till it breaks. If it breaks, very simple. If it breaks the 50 SMA on the 1 hour, this is your trading charts, then you're going to fall quickly. This white line is the breakout level. So, it's all pretty simple. This is where it broke out, right there and right there. Now, these things happen very fast during market hours, so I know it's not easy. I'm not denying it's never easy. It's never easy. The markets are going berserk. Is it easy? That's the funny part. It's not. Are we all sitting back with our, just leaning back and saying, oh, it's so easy, just leave it in there? No, we're not. That's why I'm saying if you really face the truth inside of you, nobody's euphoric. I mean, half the StockTwits guys and other forums are either trying to short the market on every 50-point move, or they're getting burnt. At least we're trying to participate in many ways. And if we're seeing any particular drawdowns like we saw here, we're capitalizing on some very quick short trades. And the rest of them are sitting there calling for the crash of the century. It's still, believe it or not, we're up here, and there's still 53% bearish on the StockTwits SPX stream. So when people say that there's euphoria, I don't think so. I want to see 90% or 80% bullish and 20% bearish. That's when you're talking. That's when you want to short the crap out of the market. We're not even close. I don't think that's going to happen either. So bottom line is, these channels are meant for you to see how the market trades intraday, so you don't have to look amazed just because you're down 60 points, touch the bottom of the range maybe, There's no reason to say, okay, now we're going to go down. Yeah, you can say that. Everyone's got a right to say it's free speech, right? But that's dumb speech, if you ask me, because you're not looking at what has been presented in front of you or your own screens, for that matter. Falling 60, 70 points, touching the bottom end of the screen, while this upwardly trending 34 and the 50-day moving average is still continuing higher, acting as major support levels, this is the time where you don't say, oh my God, we're going to complete a breakdown. This is the time that you basically scale out off your shorts, or your puts, the few puts that you have or whatever, and buy long as long as the channel holds. Because this is what I see happening a lot with a lot of you. And it's not my business. You do what you want, right? But I'm just saying, you guys never buy down here when the oscillators and stuff are starting to bottom and things are happening. Things are really placing itself to be bought. You guys are sitting around. I don't know what you're doing, and it's not that you're not buying, but you're buying up here. So you're catching a very minute portion of the move till it hits the upper channel, and then a lot of the times it's slipping, and then you're like, oh well, I think it's going to really break out. The market's going to go to 2,500. That's just hopium. What you're doing is you're just trying to tell your brain, no, the market's definitely going to go higher, without being at all technical, and that amazes me. Because once it hits up here, there is going to be some selling, because my charts are repeatedly very, very accurate, give or take a few points, because I'm not just drawing it out of the figment of my imagination. When you practice a craft over and over again, you tend to get better at it. I have a long way to get really, I think, to reach my potential, in my opinion. But I'm getting, I'm better at it than most people. So what's happening is you guys are getting up here, like, for what? You should be buying here and selling here. You don't need to reach the top of the channel. And I'm just showing you a very simple example. So whatever you do, stop doing stupid things. And I've done stupid things. I talk to myself the same way. But when I see people repeatedly doing that, it's just amazing. Well, what are they waiting for? A breakout here? That breakout ain't going to come if you're going to be sitting and buying at that level. Because this old-fashioned idea that, a breakout will be where I buy. Well, that's exactly where the algos attack with hellfire missiles. Yes or no? Absolutely. And you just get obliterated. And then it comes down, and if the market really wants to go higher, then it creates that big fat breakout candle, which we recently have seen a bunch of times. But don't get used to those breakout candles. That's not going to keep on happening. Those are not normal movements. When you see the Russell 2000 going up in 9 candles in a row in an intraday, those are not normal movements. So don't get used to that. Don't get spoiled, please. Don't get spoiled. Can there be a big fat breakout candle like that? Sure it can. And then create another bull flag, which I showed before the market took off? Sure it can. But if you're going to be a tactical trader, then you want to be a buyer at these levels, or even when it touches the upwardly rising 50 moving average at these levels, and you want to be a seller close to the upper end of the channel and leaving a little bit in there, or re-entering if you do get one of those monster breakouts. Because the monster breakouts that you get, those are meant to be bought. Those don't get extinguished that quickly. We know that. We know that. And I've shown that repeatedly. So that's a different story. But if you don't get that, then please don't go around buying here and then get walloped again. Because that's what I see a lot of people doing that, So whatever. So my thinking was, right or wrong, that the McClellan oscillator here at minus 396 is horrifically low for a 1-hour chart. So you will get a reflex bounce, which possibly could be sold here at the upper end of the channel. I'll be engaged in that and posting it, obviously, as you know. And then the oscillators here are pretty clear that it wanted to go higher. Doesn't mean that it can slip lower. Now the danger is that if somebody is very heavily into calls, and that's why I said keep your position sizes smaller and be more active during the day, because we're at that stage right now, right, where anything can happen. So this could be up here overnight. So the reset could happen overnight. I showed a 1 hour chart, which was, oh, this is a classic example. I showed a 1 hour chart when it was here. S&P futures are up about 2 points, 1.5, and I said the markets are going to now, it's a consolidation channel. Look what's happening to the stochastics. Now, this might seem really dry to some people, but you know what? It saves you a lot of money, or at least makes you some decent money. We were really oversold at the close at 4 p.m. right there, okay? McClellan oscillators were at minus 352. Look what's happening since 4 o'clock. It's 9 o'clock right now, 9:44. It's already getting overbought. So by the time you wake up in the morning, if futures are up 3, it's a sell zone. Now, I've mentioned this and repeatedly try to, teach people this stuff, but I still don't get it when some people just don't get it. But if some people still don't get it after this long, and then hearing me explain this so many times, then I can't do anything. And I'm not supposed to do anything either. So bottom line is that the fact is that if you get overbought right here and you start chasing the market right at the open, oh yeah, market's going to go higher, and then you get whopped in the first 15 minutes. End of story. That's why it's important to look at these fast stochastics from an intraday perspective, because those are giving you signals on what the markets are going to do. The algos generally tend to push the futures up right before the open if they want to go higher, and then they slam it, as you know, very quickly. This is the overall market I'm talking about, and then catch the idiotic retail traders who are buying the market right at the open. Now, individual stocks are a different story. I spotted what was going on with CMG. I read the news about them and their drive-ins and stuff. I knew there was this CEO. The news came out about the CEO, the original founder, who's a genius. Does anyone know who the real founders of Chipotle were? Where they came from? They're very seasoned professionals in the fast food business. Where did they come from?
McDonald's.
Yes, exactly. They came from McDonald's.
He was a cook.
He was a cook. So that's an American dream, like, boy. So, yeah. So there you go. They come from McDonald's. They're a worldwide franchise. They know what the heck they're doing. Now, the fact that the original founder now has taken the helm is obviously a positive sign. And there's a lot more going on underneath that you and me don't know about, what Bill Ackman is doing, all that stuff. And more importantly, I'm looking at it from a technical perspective. So given that, it was a fantastic, trade. So you don't need to necessarily, just hold everything and say, oh, tomorrow it's going to be higher. It could be slightly lower tomorrow, but at least you could have traded it during the day. For, markets were down. The thing was up, 12 points. Markets were up. The thing was up more. So it's these things, happen. Now, this consolidation channel, that's why I have a question mark here. We don't know which way it's going to go, right? If it falls and breaks down and we're below the 34 and the 50, then we got some explaining to do. Where's that term come from? From an old TV sitcom called I Love Lucy. All right? My wife's loved watching that. So there you got explaining to do. All right? Or did that come from Scarface before we were shooting people? So bottom line is that explaining to do is Daniel's favorite thing here, the breakout line, which is 2220. Is it possible? I explained to you. It's certainly possible. It's Fed week. So if we break through this, this is a very important chart. If we break this consolidation channel, please don't be a hero, okay? Then watch all the levels that I post, and but it wouldn't be that good if we broke it with a big fat red candle. That means some big boys decided it's time to step back a little bit and scare the living daylights out of the idiotic retail traders and the lemmings and the chasers, and take the market lower a little bit so they can buy the crap out of the market at this breakout zone. Remember, this is a pattern. Look at the pattern. If you draw a nice dome, this is a pattern. Does everyone see that? Yes?
Yes.
There you go. That's a dome pattern. It's an igloo. And so bottom line is this pattern pattern, in my opinion, just a gut feeling, can happen by Fed Day, on Fed Day. And if it does happen, you got to buy with both hands down, depending on the circumstances. But from this vantage point, I would say that would be a terrific retest of this big, fat, monster breakout that no one expected. No one. Okay? And that would be pretty sweet. Go ahead.
Why would I not consider that an upside down cup?
Yeah, you never talk about upside down cups, because if a cup is upside down, it's not a cup, right? No, it's a very good point. Yeah, you can call it an upside down cup. I'll use that term. I mean, normally a cup and handle is, a cup, a handle, a consolidation, and then a breakout, right? That's a cup and handle. So, yeah, you can consider an upside down cup or just a topping formation. You know what I'm saying?
Is there another name for it, so I'm not mispronouncing the design that I see?
I don't know. I really don't know. I don't think there's a name for it. I'm sure there is. There might be a technical name for it. It's a good point. I'll look into it. I call it the dome or the topping pattern or pattern symmetry, So that's the topping process. Multiple tops and then,
Clueless igloo.
Yeah, clueless igloo, right? There you go, man, So, yep, there you go.
Good enough.
So the bottom line is that this would coincide with this breakout. That's the point that I want to make, is that would, unless the market really wants to break down and something terrible happen, which obviously I'll be, posting for my members, then this would be a significant buying point, You want to, Otherwise, if it breaks that, then we're looking at 2180, which just about till last week, before last week, I said was a major support level. If you remember, we never got there. We just broke out. So 2180. So that's it. So this dome pattern is what would be significant, because it would create some technical damage quite a bit. I don't know if it's going to happen. Maybe this uptrend line, given the ferocity and the power in the markets, maybe this is the most we'll get, this uptrend line, maybe a little slippage, or maybe at the bottom of the consolidation channel, 2240, 2243, and then a breakout. So that's it. Now, in the meantime, now I'll leave it because I've covered all the basics that we need to be covered right now when it comes to the overall market picture and stuff. I'll entertain a couple of questions, and please go ahead.
Hey, Frank, after the Fed meeting,
yeah,
when you think companies like Apple and Microsoft, you should buy with the repatriation that's probably going to come back?
Mm-hmm. Yeah, but the thing is that a lot of those stocks have already shown like they say, buy the news, sell the rumor, right? So if the Fed, no, I hear what you're saying. If the Fed meeting goes okay, is that what you're saying? If it goes smoothly?
Yeah. If it goes smoothly, then the next big event is going to be the repatriation.
Yes.
That's money coming back.
Yeah, I agree with you. If the Fed meeting is taken well by the markets, which I think it will, then we should be looking at buying some of these, whether the Apples and the big cap companies and stuff. Absolutely. Just keep in mind that on a technical basis, the markets are very overbought. So generally, the first couple of days of January, the market overshoots. Like I explained, that's when we can go to 20,200 or so. But after that, you get this technical selling based on tax deferments that are sold, and and so those things have to be taken into mind. And but I still think, in my opinion, if we look at the QQQ, right, it is, in my opinion, which I've shown this chart before, and in relation to Corey's question, is about to make a new high, because this is one ascending triangle. This was a consolidation triangle. These are going back to January of this year. So you're not talking a couple of days. This is a very defined chart. Okay, you guys, can you see it? Right? So you have, everyone see this?
Yes.
So this one looks to me very much a consolidation, sorry, not consolidation. This is a consolidation triangle. See how it just kept on going like this, like this, like this, and then boom, it broke down actually, came straight back up and didn't stop. And this was obviously Brexit. This is an ascending triangle. I'll call it AT. And this ascending triangle at first glance looks like it wants to, after it zigzags around a bit, wants to break out, right? Now, what's obviously the main stocks, the Apples, the Amazon, the Googles, the Pricelines, the Facebooks, all the stocks in the NASDAQ 100 have to participate, whether they like it or not. They, if you buy the basket of the Qs, you're buying all of them in one shot, right? So when the funds come in and the hedge funds come in and the institutions come in and they get into these techs in a big way, they already have in some cases, this will break out straight out. And don't be surprised to see 125 or so on the Qs. So that itself, in relation to validates Corey's point that those things get bought. But it'll happen very fast. You always have to be positioned right, and that's why individual stock charts are important. Okay, technically,
Hey, Frank,
go ahead.
Is there a time frame or a meeting announcement that alert you sent out earlier about basically all the tech stocks that are meeting with Trump on Wednesday? Is there a time that's coming out?
I don't know the exact time, sir, but I believe it's Wednesday morning. Wednesday morning, and so I think it's really, it's really bullish because you got the Fed meeting, and you got these big wigs all showing up there, and that's the beauty about America. You guys, we keep all our differences aside. If you think about it, campaigning is one thing. Now he's got these big wigs coming in there. If they get into a spitting match and a fist fight, you can short the crap out of all the big tech stocks, right? So I don't think that's going to happen. But then if Bezos comes out and said he had a constructive meeting with Trump, you better buy the crap out of Amazon because it's going to be up $30. And the chart on Amazon is pretty decent. So that's what I'm saying. It's so this is definitely a constructive event in my opinion. That those guys are meeting listen, capitalism is about self-interest, right? So the tech companies are looking at their self-interest too, and they want to make sure that they don't that they work productively, constructively with the new administration. And I'm sure that Trump and his advisors and stuff want the same thing. So I think it's a plus thing. And this ascending triangle, in my opinion, gets broke, boom, out, gone. It's going higher. Now, if somebody says, okay, well, how do you say that? It's overbought. Well, let's take a look at the monthly. Let's take a look at the monthly. And if you look at the monthly chart here, and I showed this on the S&P, and I'm sure many of you remember, more than a month ago, and I said, does this look like the market's going to go lower? Do you guys remember that? I showed, I didn't show the Qs, I showed the SPX on the monthly. And you guys said, no, it doesn't look like. Well, that's exactly what's going on. Sometimes you got to cut out the noise of the daily grind, the weekly. I'm going to cover Bank of America in a quick second, Exita. And then look at the monthly. What is happening on the monthly? Well, if we look at these, let's hide all these lines so it's easier on the eye. Does this really look like, I mean, sometimes you just got to be really simple. Keep it simple, stupid, right? KISS. Does this really look like a chart that's looking like crap and about to crash? Yes or no? No. And if anyone says, yes, it really looks like it's going to crash, then they're really being idiotic. I won't even respond to that. This in no way or form. Yes, technically I can show you it can pull back to this line or that line. I'm just giving the broader picture. The broader picture. Since July of 2015, when we had a monstrous decline in the market, which very few people remember, that was a monster decline. Okay. We have had an ascending triangle building. Now, this is longer term picture. That doesn't mean you're not going to get a 15 point down or 30 point down day on some of the big cap moving stocks. That's not what I'm saying. I'm just saying that this, let me draw this out. From a technical perspective, and of course anything can change. I will pull that full disclosure. Anything can change. Apple can come out and say they're frauds and every iPhone is going to blow up. I'll go back to my old Blackberries, which are lying somewhere out there in my drawers, and it's going to be all over. So, but barring that type of scenario, let's take a look here. Price level. Oh Lord, this is already broken out. So I normally don't look at the QQQs that much, but please take a look at it, ladies and gentlemen. You don't need to subscribe to Goldman Sachs to get this good stuff that you get at Clueless Day Trading. This ascending triangle, ladies and gentlemen, has already broken out and creating another channel, which you can see here, within this Darvas, upper Darvas, on a monthly basis, with the upper Bollinger of 121, 122. If you don't want to trade during the day, which sometimes is a very smart thing to do, to be honest with you, okay? You could just buy some maybe early January calls or even end of the month calls on the Qs, which are not expensive. They're not super expensive like the SPX and stuff if you're trying to buy them in the money. But you can throw some out, test some out, and buy the 121s or 120s even, 120, 121 calls for the first week of January, over the end of the month. Because this is going to go there. Of course, the returns on your money on playing and tactically playing, like I keep showing, the Amazons and the Googles and stuff will be higher, but you'd have to deal with higher volatility. But here you can buy these things, and this basically this is it. What's your low end? The low end is 116. That's your support. The ascending triangle breakout is your support. So on a bad thing, and Janet Yellen says she thinks that every single tech stock's in a big, fat, ugly bubble, you're going to fall quickly to the uptrend line here at 113. I'm giving you a real extreme scenario. It's not going to happen. Or on a simple move, what is this pattern here? I mean, what is that candle called? Come on, it's pretty obvious. You guys should know this by now. And Corey, please.
Hammer. Hammer.
I told you not to answer. Okay, I want others to answer too. So yes, exactly. It's a hammer reversal. Does everyone know what a hammer reversal looks like? Because if you don't understand what a hammer reversal looks like, you're in trouble. This is a hammer reversal, okay? Where you have a long tail and you have the body of the candle up here. That's a hammer reversal. Pick up a hammer and you'll see. And if somebody's never picked up a hammer, God help them. All right, so that's a hammer reversal. And these are very important, powerful. This is a massive hammer reversal, even though the body was red, because the following month it went down. This is a hammer reversal. These things, when you buy these things, this is a small hammer reversal, okay, just like this one. The longer the tail, the further it's going to go. So this one, the tail is smaller, so that's why I'm saying it probably goes to 120, 158, 122. Based on the upper Bollinger. So you need to be a rocket scientist to figure this out. Now on a monthly chart, the techs are going higher. Now interim on a 1 hour, on a 1 day, on a 4 hour, yeah, it's going to do all kinds of crazy stuff. But on a monthly chart, the techs are going higher. All this scenario changes if we fall below this uptrend line, or if we fall below this breakout line right here, wherever that is, 115 and change. And if we break this, then you can short it all day long down to 106. That means every single tech stock that you know, Apple, for example, will go back to $100. Apple will go back to $100 if this happens. But barring that, it's going higher first. Let's take a look at Bank of America. So this is a very important chart here, okay? This QQQ. I didn't even realize because I haven't seen the monthly chart. It's the first time I'm seeing it with you guys. Where we are above the ascending triangle. And that's a beauty. And we are creating this Darvas box, this channel, this magenta line, right? You can see that. It's there. It's real nice. It's just moving in between that. And we freak out like, oh my God, what's going to happen, you know? Well, as long as the Darvas holds between 115 and 117, I'm sorry, let's say 120, you're fine. If this stair steps down like this, then you know something bad is going on. On a monthly Darvas, which is this pinched, okay? This pinch, I mean, it's a very pinched Darvas. Look at how narrow it is. There. You are either going to break out in a big way, that's what it looks like for reasons that we just discussed, or you're going to break down, period. This is a pinched Bollinger, a very pinched Darvas box. But it's a pinched Darvas box which has gone from here on the monthly to here. So overall, the bottleneck is suggesting another Darvas, another a trading range developing at this level. Everyone understand this? I mean, I just forecasted something real important. Yes? Everyone get this?
Yes.
Okay. Anyone else say yes? Yes? Okay. If this does this, and you can do this on your own screens, okay? Then you know, regardless of what you tell me or anyone tells me, we're going lower. How much lower? Well, we could go lower. When the Darvas starts to step down, stair step down, it simply means there's more selling to come. Now, this is on a longer term chart. Don't try to do the Darvas too fast on shorter term frames. So on a monthly, this is, I think, what's going to happen. We're going to get up to this level and then maybe breathe. Take a rest. All right, Bank of America. 1 second. You wonder why, sometimes I wonder, and I'm not saying in a bad way, you know, like there's all these smart guys out there. I read a lot. You know, I'm always putting up these technical charts, technical articles that I like, and I screen them fast in my head before I put them up there. Like, why none of these guys ever show these type of things? It's just incredible. They're not stupid. It's a mystery that I just don't understand. I have seen this year after year. Look, I'm not a technical genius in any way or form, and I mean that. But these are so transparent if you understand some of the basics. So transparent. And yet, I don't see anybody doing it. And if you do see guys who do that, I'd like to, you know, I mean, honestly, in a nice way, like I'd like to see them. It's pretty wild, I'll tell you. You guys have other services, stuff that you look at or, you know, think. Do you have, and I'm just a normal question, I'm just asking, do you have other guys who are drawing charts and explaining it in this fashion? Just curious. Anybody?
Nope.
Anybody? No? Funny. I want more people to do it. I shouldn't be the only one explaining this stuff, you know, like that. But hey, you know, God bless them. I don't understand why we don't have 1,000 people as members. I really don't. I know why I don't, because I suck at marketing, like digital marketing. And that's why I always tell people, which amazes me sometimes. So I do have a major complaint against you guys, that even on great days where you guys are all participating and doing well and stuff, I very seldom see anybody going out there and mentioning the service out in the other forums. And that to me is not nice. And that's most I'll say. It's not nice. It's very selfish because we do organic marketing. Okay? We do organic marketing. And so if a quick shout out somewhere or a mention somewhere is really that difficult, I don't know what to say. So just letting you know. Okay, so Bank of America, looking at it very simply, is in a very bullish pattern. Here you have the monthly chart on Bank of America, and we have the upper end. This is that big, ugly downtrend line. The downtrend line of Bank of America does not get engaged till $25.29. $25.29. Most importantly, the white line here you guys are looking at is 150, in this case 150 month moving average. It's actually 150-day moving average, which is used by hedge funds a lot to track a major momentum change. Now these guys, but you're talking about happening over weeks, okay, even though it's a monthly chart. So so engaging the 150 at 24.26, believe it or not, is very doable. Very, very doable. Now you expect Bank of America to move $4 in one day, then you're smoking something that you shouldn't be smoking. It's not going to happen. Can it move $2? Yes. Can it move $4 when it's a $20 stock? Nope. Unless something major happens. 20% move on a $20 stock, that's a $4 move, right? 20% on a $20 stock, just not going to happen, especially in a widely distributed stock like with a huge float like Bank of America. So saying all that, you have, this is your point of engagement. It has not engaged this point ever since the big drop. People forget it used to be a $60 stock. But this is very bullish. Now, it is overbought. It is above the blue line here, above the Bollinger. So do expect some consolidation, minor. One way you can see where it shouldn't fall under, and Bank of America is primarily held by institutions. So they don't give up that easy, but then the institutions are like lemmings too. They panic and they sell if there's a big sort of event risk. So this is the level here, 1984 or so, 1994, call it $20. The stock should hold 1990, 1960, okay? 1980, how about that, 1980. So 1980, you don't want it to fall below 1980. Yes, it can't, see this yellow line? That's the 5-day moving average. In this case, it's the 5-month moving average. And the 5-month moving average is 1850. So it can go as low as 1850 and it's still fine. Anything below that, then we are basically talking about retesting 16s again. Who knows? You know, that's a pretty dramatic move down. With the amount of money that's gone into Bank of America and the financials, I highly doubt it unless the institutions decide that banks are no longer a play and they want to get out of it. That's a different story. But this is very bullish. Upper end of the channel is $28. We're talking about months ahead. And the upper end of this massive Darvas box is $40. Can it happen? It sure can happen, probably by mid next year or so. Now let me show you one other way of determining where Bank of America can go over the longer term is, 1 second. In fact, this could, Bank of America, if you really think about it, from point one where we started to buy it and times, if you just traded Bank of America and those penny options, you'd be rich. I mean, really rich. Sometimes you think about it, why do we have to look at so many stocks when something's on a major uptrend and costs 30 cents a call to buy, and they go to $3 on big moves? Really, seriously, if you think about it, you could just buy a bunch of it and just leave it in there. Let the markets go up and down sideways and Google fall $5 and everyone's like, okay, we're crashing and all kinds of stuff and we're finished. And I'm like, here's a bad red candle coming, this and that. You can disregard it. These are the types of stocks which are worth keeping. So bottom line is it engages this level at 23.54. So here's a Fibonacci retracement. If you want to look to see where something has come from where to come, over years or over months, dramatic type of ranges, you can only use a Fibonacci retracement, in my opinion, as a guide to where it might go. And I said this before when the stock was rising, and it did exactly that. So here's your 0. Here's your 23.6, which was 15. See you later. We're above that. 22.67 is your 38.2 Fibonacci. Fib. Generally speaking, a massive waterfall decline over a period of 2008 to 2009. If you notice, Bank of America basically did nothing. Not nothing. I mean, it still went up from $5, but it never really, it finally broke out. That's why I'm saying the $24 level is, I think, where it's going. And it's going to happen quickly. Normally speaking, when you have this type of broad decline, asset prices tend to rebound back to the 50% retracement level. And the 50% retracement level, I'm sorry, is $29. Call it 30. So eventually, Bank of America, who knows, maybe by the first part of next year, gets to $30. That's when the Dow basically gets full scale, like euphoria. Who knows? But that's what we're looking at here. You have a bunch of levels, and you can, and I think this is where it engages first. About 20. We're close to that 2267. Oh, we're close at 2261. Okay. So basically here it's going to find some major resistance. But a breakout over the $24 mark is just going to be like very fast. Any other quick ones I should look at? I'm open. I mean, I have time, so go ahead. Anyone? All right. So, good.
Hey, Frank.
Go ahead.
So if the rates go up on Wednesday, the dollar usually appreciates. So does that mean people are going to be throwing money back in gold?
Okay. Remember something about life. Buy the rumor, sell the news. You don't think the dollar has appreciated already because of the fact that the Fed is going to raise rates? More importantly, have you been noticing what the 10-year bond is doing? The 10-year bond is on a massive breakout. I've been talking about this a bit. So let me explain this to you real clear. The 10-year bond is on its way to going to 3%. Anything above 3%, the market's going to basically panic. That's when they'll think like, oh, Lord, we thought interest rates were never going to go higher, and now they're just going through the roof. Whichever the case, from a technical perspective, the 10-year bond is on a clear breakout. You see that clearly, right? Brian?
Yes.
Okay. So the 10-year
Yes.
bond is on its way to getting up to 3%. Can't give you a time frame, but it's going to happen soon. Not in a day or two. In that case, the market will be like, whoa, 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 hold on a minute here. Rising rates are fine, but parabolic rising rates scare markets for a simple reason. Markets are very myopic. They're very short-sighted. So when they see a rapid movement on rates, they start to get nervous. But from a technical perspective, it's going to about 3%. So the fact that it's risen from, remember, this is the 10-year bond. Brian, do you know what this 12.5 means? Or this 13.75? What this axis here, okay? The y-axis.
No, I don't.
Okay, you move the decimal. I've said this before, so focus this time. This is an interest rate yield chart. It doesn't mean that the 10-year government bond yield is trading at $27. You move the decimal to the left, it basically means 2.75%. 30 means 3%. Do you understand what I'm saying?
Yes.
If you don't understand, don't say yes. All you have to do is move the decimal to the left, and that's you get your interest rate thing. All right. So when you look at your screen and TNX, it's showing 24.79, which basically means 2.479. Got it? So we are roughly at 2.5% right now. We are roughly at 2.5%. So that's how you read it. So the fact that rates have gone up from 1.3%, which was not too long ago in July, rates have basically gone up how much? From 1.3 to 2.5 is roughly how much percentage-wise? Quick.
Almost 1.
Almost what? I said percentage-wise, 1.3 to 2.5 is what? This is where I get really scared with trading. Excuse me? Don't worry, I'm not going to hammer you, but I'm just trying to understand what you're thinking. If something goes from 1.3 to 2.6, what's the percentage move?
100% then, right? It's a 1% move up.
That should be your answer without thinking, 100%. That was my question, right? Yes?
Yeah, I'm sorry. I thought you were saying what as a like
No.
a 1%.
Well, that's a lesson learned because you're not a full trader yet. You're learning. Traders have to think at lightning speed. You overthought my question. You overthink your trades. That's why things go wrong. Do you understand what I'm saying? Don't overthink. I asked a simple question, but at least you're the one who answered. Nobody else did. So I'll give you full A+ on that. Everyone stayed silent. So rates, basically, the point that I'm making is rates have gone up 100% since July. Correct? Does everyone understand that? From a percentage move, rates have gone up 100%. Does everyone understand that? Please say yes, because I'm getting tired here, guys. Tell me if you don't understand it, and if you don't, I'll explain it.
Yes, I get it now.
I'm not asking you. I'm asking some other people. Is everyone sleeping? Am I talking to myself? All right, forget it. So bottom line is that rates have gone up 100%. So the point that I'm trying to make, Brian, is the US dollar has already reflected that in its price, and that's the reason why it ran up so much. You understand what I'm saying? So I'm not saying that the dollar can't go higher, but just like anything else, the market's a discounting mechanism, right? So it tends to move before the actual event happens and then sells off after the actual event happens, like what happened with oil today. You get it?
Okay.
Yeah. So in answer to your question, yes. If they raise rates, which they're going to raise rates, but give a moderate guidance, the US dollar is going to do what, you think? If they raise rates and give a moderate soft guidance, what do you think is going to happen to the US dollar?
If it's not going to appreciate too much, it'll probably just stay the same then, relative to what it is now.
You are correct. It's going to fall. Because in the world of financial markets, nothing really stays the same. They either fall or they rise. So here's a dollar. It certainly looks like it wants to go higher. No question about it. It is, however, on a monthly basis, not even on a daily basis, seriously overbought. You see this? Right there. See that? And when the dollar gets this overbought, it tends to appreciate down. So yes, the trajectory of the dollar is higher, but depending on the Fed's guidance, every currency trader and serious currency trader out there is trying to figure out whether they should buy the crap out of the dollar. And we don't want the dollar to rise that fast, that quick, because that hurts markets. You understand that part, right? It starts to crimp corporate profits on a multinational basis. It really sends some fear in emerging markets because strong dollar, they got to pay back their debt in dollars, and it's not fun. So yes, we want a moderate guidance, we want a rate hike, but we don't want sharp language which projects, in which case the dollar is going to really go. But on a monthly basis, the dollar does look higher. But let's see on a daily basis. On a daily basis, the dollar looks like it's going down. Because when you see this thing here, one second. When you see this, this is not a trade I normally buy. If I was looking at a stock chart, you got one real ugly candle, which I showed the other day. Then you got a big hammer reversal off the 34-day moving average. That's expected, the first bounce. Then you get another outside day bearish engulfing red candle right here. So if the Fed's a little bit moderate and the market reads into it that they're not really hell-bent on raising rates every single meeting, which I don't think they are, then the dollar's going to fall. Now, dollar doesn't crash. It's probably going to come down and rest somewhere. As long as the dollar stays below 100, it's good. If the dollar goes above 102, 103, no good. This is the dollar index you can track on your charts. Can you go over one? Of course. Go ahead, Exita. Which one? X, yes.
Hey, Frank, while you're doing X.
Oh, yeah, go ahead. I'm doing X here.
While you're doing X,
yeah.
Can you give us, be a prophet, what do you think is going to happen on Wednesday? Your thoughts.
I already told you what's going to happen on Wednesday. Were you missing and have the meeting?
No, I listened. You gave scenario 1, 2, and 3.
Oh, I think they're going to raise. Oh, you were asking me what I think my gut is. Yeah, I think they're going to raise it 1/4 percentage point, and she's going to be pretty dovish with her comments about further rate hikes. I think Janet Yellen and company, remember, nothing happens in public. It all happens in private. Donald's Treasury Secretary, Steve Mnuchin, right? He's very fond of Janet Yellen, okay? And I believe they've had some very constructive conversations, and the Fed is going to be very cooperative with the fiscal policy. And the other thing that would I forgot to mention that would be very positive for the markets is Janet Yellen mentioning the fact, which she's been saying this for years though, and I got to give it to her on that you need help from the government, which is called fiscal policy, and not just monetary policy to grow U.S. to increase U.S. growth. So now that we're getting fiscal policy growth, it takes the risk, and listen to this carefully. It's very simple. It lessens the burden on the Federal Reserve Bank of America, the Fed, to keep on tweaking the economy with stimulus of their own. They would rather have the government pick up on the stimulus side, so the Fed becomes a lesser player in the financial markets. Does everyone understand that? And if she even mentions that point, the market's just going to go whoop, 20,000, because that's a good thing. And that's exactly the way it should happen. The government should take some responsibility, a lot of responsibility, in stop the infighting and get things done. Period. That's why the voters voted. So once that logjam is out of the way, it takes the pressure away from the Federal Reserve to keep on being the sole player trying to hold up the global economy and the U.S. economy. Everyone understand that? Okay. X, daily chart. Definitive sell mode on the daily chart. Now, why? I'm going to give you quick pointers here. Look at the standard deviation between the 34 and the 50 and where the stock is. This is known as an overshoot. Whoop. Does this mean it's going to come down all the way to $27? I don't think so. This is a major uptrend. However, if the daily breaks, and again, this is where the Darvas box comes in. If the daily breaks below the Darvas, and the Darvas does this, because right now it's resting on this big fat uptrend line, sort of an ascending triangle kind of thing. If the Darvas goes like this a little bit on the daily, not a good sign. And if this one goes like this, nothing bad about it. It's just consolidating. The buy zone, in my opinion, would be a very optimal buy zone, would be somewhere where there's a minor gap here, and that's around $32. Okay? It would be perfect. Will it go there? No, because everybody else wants it to go there. I don't think so. I'm not an expert on X. I just figured that the stock would take off, after the elections. This is certainly overbought. We have a lot of support along the way. We have let's see, we have the mid-Bollinger, we have things. But I do realize one thing, that it is quite overbought for the distance here. But then at the same time, you can't blame X. It's finally waking up. So it's in fine shape. This is the consolidation channel, 3 candles, just the way it was 3 candles on the way up. So it could be finding support pretty much at this level here. Now, if you want to take a look at it on a monthly basis, the stock has a lot more to go. So it all depends on your time frame, right? So on a monthly basis, you have a 150-day moving average at $46.49. If this move on materials is real, ladies and gentlemen, X has a beautiful cup, which will move it up to that $46 range right there. Now, this will take weeks and months, maybe weeks, not months. But this is where it's going. Now, here you have massive resistance, because that's what it was in September of 2014. No, but if it takes out this level at 46, the next level that comes into play is, sounds hard to believe, $72. So there's some pretty significant stuff going on. Now, in between, if you look at shorter term, this is a monthly picture. Look at the weekly on X. You still have that cup formation going on. The upper end of the cup is still 46. So 46 is On a real move up on the market, this stock can bust a move to 46. Along the way, there's one level of resistance at 42. Looking overall good. We do have one candle here. We don't want to see this candle becoming a longer expansion red candle. Then we don't like that. But aside from that, the sector is very fine, and unless the dollar really goes berserk on the upside, most materials should perform pretty good. Let me show you one other way you can track. I mean, to measure this, take this line here. Take this line here. Sorry. Okay. And then you notice how perfectly it's resting. This is the channel. How perfectly it's resting on top of the channel. So you don't want this yellow line, very important. The 5-week SMA is at 33. As long as it keeps on pointing higher, you're going higher. If it starts to curl down, you're going lower. So the 5-week SMA, the 5-day SMA, these are important lines. Okay, so start tracking that. You can have the 5 SMA, just letting you know for people who are into X or holding it for the longer term. Even if it crawls down, let's say it goes like this, and the stock heads towards, let's say, $30, as long as these keep on rising, it is the dips are buying opportunities. Is everyone clear on that? So that's what I'm saying. You can have the 5-week SMA starting to turn down a bit because things are, just went up in a straight, 90-degree angle. But as long as the 50 and the 34 keep on crawling higher, then you're going to be fine. All right. Any other quick stocks you want me to look at? Because I think we're going to wrap up. I'm already late for something. Okay. All right, guys. So this is going to be uploaded right now. God bless you all. See you guys tomorrow. Agzita, I'll talk to you. And everyone stay well. Just be cautious a little bit. Trade with one eye looking back. Look at my charts. Do the right thing. I'm always there. And good luck to us all. And it should be fine. It should be a good, solid December. Take care. God bless.
Thanks, Frank.